Hi, and welcome to Ask an Economist. I'm Hayden.
And I'm Matt.
And Matt, you're an economist.
And you're not.
That's right. And I've got some questions for you. So the RBA have just increased interest rates. Now, before we get into it, why don't you just tell us, what is an interest rate? What does it actually mean?
Yeah, so an interest rate is basically if you want to have money now and you don't have money, you have to pay a price, and the price of having money now when you don't have it is interest. It's the amount you pay for getting money. So the biggest borrowers in the economy and the people who will be most affected by this interest rate increase are people with mortgages, because they borrow hundreds of thousands of dollars.
So that means that their mortgage repayments are going to be higher every month or whenever they pay it back.
That's exactly right. So these interest rates going up mean that on, say, a mortgage of $500,000, they'll be paying an extra about $70 a month.
Okay, so why don't you tell us why they've done this? What's the reason behind it?
Well, basically, the RBA is trying to make people poorer, which might sound a little weird at first, but effectively the RBA thinks that inflation is largely being caused by too much demand for goods and services, and they want people to spend less money on goods and services so businesses don't put up their prices. And the way they do that is they increase interest rates so that people with mortgages pay more in interest, and they have less money to pay on other stuff. So this interest rate rise is probably just the first in a series. The RBA signalled in their minutes that this will be the first one, and they're expecting to increase it further. And as they increase it, basically each month people will have less and less to spend on other things because they'll be spending more and more on interest payments.
But Matt, I thought the inflation was caused by the war in Ukraine.
Well, exactly right. So this is the problem. The inflation that we're currently experiencing is not being caused by demand. It's being caused by what economists call supply shocks. So increases in oil prices, increases in fertilizer because gas prices have gone up because of the war in Ukraine. After we've emerged out of COVID, there are supply chain constraints and they're not able to ship goods around as effectively. So there's a shortage of stuff, and that's pushing up prices. Now, making people poorer, that is, making them have less money to spend, isn't going to fix that kind of inflation. I mean, if we put up interest rates in Australia, that's not going to do anything to the world price of oil. And if the world price of oil is part of the problem, then that's not going to affect inflation.
And now the big one that we want to talk about today is house prices. So we know that they've been soaring for ages. How is this going to affect house prices?
Yeah, it's going to have some effect on house prices. House prices went up recently, largely because interest rates went down. So when you go along to the auction to buy a house, the first thing you usually do is you go to the bank and you go, well, how much can I borrow? When interest rates went down, people could borrow more. So everybody turned up to the auction with more money in their back pocket. So the price went up. Now that interest rates have increased, they will have less money to be able to bid, and we'll expect house prices to at least flatten and possibly even fall a bit.
So for me, Matt, as a wannabe, maybe once upon a time first home buyer, is it going to help me buy a house? What's going to happen?
Well, I mean, yes, house prices won't be as high, but interest rates will be higher. So it's a trade-off, right? So we saw interest rates went down, so you might think, oh, will you be able to afford a house? But house prices went up, which made them less affordable. Now, as interest rates go up, yay, that might bring house prices down and make them more affordable, but you're paying more interest. So it really is a trade-off. And basically what it means is, actually, it doesn't really matter for housing affordability what the interest rate is in the long run, because house prices will coalesce around whatever interest rate it is. The lower interest rates are, the higher the house prices will be. The higher the interest rates are, the lower house prices will be. But it'll be equally unaffordable if you can't afford to get in.
And what we're really seeing here is like a triple whammy for people like myself who don't own a house and maybe would like to one day, because wages are low. We know wage growth has been stagnating, so people have less money, but then they're also needing to spend more money because, as we said, the inflation is high, so goods and things cost more. But then as well, if you're trying to save money to buy a house, you're going to be looking at your interest rates that you get in your bank, right? And so I know on my bank at the moment, I get 0.5% interest, which...
basically nothing.
Yeah, it's not a lot. And maybe like 20 years ago, interest rates were about 6 to 8%, which is a lot more, and it helps a lot if you're trying to save money. So what can we do about it, Matt?
Well, you're right. It is a triple whammy in the effect that real wages are falling because inflation's particularly high. Inflation numbers came out recently at 5.1%, whereas wages are only about 2.3% when we measure them using the wage price index. And so real wages are actually falling. That is, the amount of stuff you can buy is getting smaller and smaller with your wage because the prices are going up faster than your wages are going up. And now we also have the situation where interest rates are going up. So that means that those with mortgages are likely, as we said, will have to pay more. But also people who rent, it might be that landlords start basically increasing rents because they've had an increase in interest rates, and so therefore their costs of running the house have also increased. So we're looking at this big squeeze, and this is the problem. Usually when we see the RBA increasing interest rates, it happens when there's lots of demand in the economy. The last time it happened back in 2010, wages were increasing quickly, there was lots of demand in the economy, and so therefore effectively the increase in interest rate was trying to slow that demand. And while people were worse off, they were worse off in a place where wages were rising rapidly. Now we've got the opposite situation where they're increasing interest rates at the very time that real wages are falling, and that's quite dangerous for the economy.
Not looking all too good in the economy at the moment. Is there a little pathway out, Matt, that you think can give our viewers some hope?
Well, I mean, the RBA isn't going to increase interest rates until the economy goes bust. They're going to do it incrementally. They've done it by 0.25%. They're likely to do it in small little increments, and they're likely to stop each time they do it and see what effect it's having. So hopefully they're smart enough to stop increasing interest rates before it has too much of a negative effect. The other thing to remember is if this is all about the inflation that we're currently seeing, this supply shock inflation isn't going to last. World oil prices aren't going to continue to go up. Petrol prices aren't going to continue to rise. They're likely to come back down soon. The war in Ukraine is likely to be either to resolve itself eventually, or we're likely to see new markets emerge and the economy will basically wrap itself around. So while increasing interest rates is not going to do much for this inflation, time might actually decrease this inflation. And if the inflation goes down, the RBA might think, well, I don't have to put interest rates up by as far. So there is hope, but we'll just have to wait and see. There's a lot of uncertainty at the moment.
And so basically, to sum it up, the verdict is interest rates going to affect house prices?
Yeah, it's likely to, but that won't necessarily mean they'll be more affordable. It just means that you'll be paying more interest on a lower house price.
Matt, you've mentioned to me before, the other interesting thing that's going on here is a conflict in what the government's trying to do and what the RBA is now trying to do. Can you explain that? Yeah,
look, so we're in the middle of an election campaign and the government's currently going around, and the opposition to a certain extent, and certainly the Prime Minister's out saying, his priorities are jobs, jobs, jobs and jobs. Well, now that the RBA has put up interest rates, the RBA is effectively saying that there are too many jobs. There are too many people with jobs. They want to reduce incomes. So if they increase interest rates, then people will buy less stuff. We need less people to make that stuff. So unemployment will actually go up. So at the moment, we have the government trying to inflate the economy, to grow the economy, to make more jobs. And we have the RBA trying to shrink the economy, to slow it down. It's a bit like driving your car with your foot down on the accelerator and the brake at the same time. They're effectively working against each other. And so every time the government tries to inflate the economy more, all it's actually going to mean is that the RBA has to put up interest rates even higher.
So Matt, have I got this right? There's a whole lot of weird stuff going on. It might make houses cheaper, but it also might not. The government's also trying to do different stuff. Everything is a bit weird and no one really knows how it's going to turn out.
Do you want me to summarise it for you?
Yeah.
This interest rate increase means that the RBA is trying to slow the economy down at the same time that the government is spending lots in additional stimulus and is trying to grow the economy. It also means that house prices might become cheaper because interest rates are lower, but the higher interest rate means that you probably won't be able to borrow as much.
So Matt, give it to me straight. Am I ever going to own a home?
I don't know. I don't think interest rate tinkering is going to allow you to buy a home. I think there are deeper structural issues, and if people who are unable to get into the house market really do want to, then the government is going to need much bigger reform.
All right, thanks for that, Matt, and thanks for watching. And if you'd like to see more of our content, please make sure that you subscribe to us and hit the bell button to get notifications when we release a new video.